Well, Tom Porcelli, what was the Jolt survey like yesterday? What did it indicate to you?
Yeah, look, I mean, there's obviously quite a number of job openings out there. They're pretty much across industries. I mean, it's that's certainly an encouraging development. We would need to get those bodies into those openings, of course. I mean, look, we've done a good job of clawing back, the vast majority of job losses right now. I think there's a long way to go. No one can delude themselves into thinking otherwise. But I think if you think back to March or April, I don't think anyone thought that we would have been able to claw back as many of the lost jobs as we did. But again, there's a long way to go. I mean, look, when I think about sort of the current quarter, particularly as it relates to sort of the stimulus back and forth, Q4 was always going to be a soft quarter. I mean, we've always had a one handle penciled in for Q4. I mean, regardless of whether or not we were going to get any stimulus, I think that remains as true today as it did yesterday.
The dynamics, the multiple dynamics, Michael McKee of the Jolt survey, is about the demand for labor. What did the demand for labor indicate?
Well, it's interesting. It's the first slight fall in 4 months in job openings, which does suggest that we have reabsorbed some workers into employment. But the problem is going to be, as Tom was alluding to, the matching of people with jobs. The number of jobs out there that are advertised that the Bureau of Labor Statistics is able to pick up is going to be different from perhaps the pool of available labor. If you have an opening in a factory, the cocktail waitress who lost her job may not be qualified for that. So this is a problem we had during the expansion that finally started to get solved a little bit, but is going to be back now.
Tom Porcelli, we talk a lot about policy, the lack perhaps of fiscal support, what monetary policy is, and with the shutdowns coming from a number of regions. But it is really the virus very much in the focus right now as it spreads. And can you model economically the ramifications of allowing a virus to get worse just as flu season starts to tick up? Are you starting to measure for that or track that at all?
Yeah, so, as I sort of glossed over just a moment ago, our view has been that the virus would sort of be, even more resurgent in cold and flu season, thus, sort of really suppressing economic activity. I've found it interesting that there's been a lot of adjusting of economic forecasts because of the lack of stimulus. I don't know that really was going to make a difference one way or the other. I think that if the virus does become more resurgent than what we've seen over just that sort of that June, July window where case counts were rising in a handful of states, if it becomes broader than that, which again is sort of what we've baked into our numbers, then I don't think it matters how much stimulus you put in place for today. Q4 is almost certainly going to be a pretty soft quarter. In fact, what I would say is, look, I think most people that read our research know that, we rarely hedge. We're happy to sort of stick our necks out there. But when I think about Q4, I think about, our plus 1% that we have penciled in. But ask me where the tail risks are, because the left tail risk is enormously wide. And qualitatively, what I would tell you is the left tail risk is that you see a replay of April. Now, let me be clear. I don't think that's what's going to happen. If we did, we would have put that into our numbers. But we have to acknowledge that that's a risk. That these sort of state government officials go through the process of really sort of shuttering things again to that degree. And that's the left tail risk of the distribution when I think about Q4 growth.
Tom, naturally, we spend a lot of time in these conversations thinking about where we're going, speculating about the future. I think it's equally as important sometimes to reflect on where we've been. We've surprised to the upside through the summer, into September, and even as we sit here in October, looking back at some of the recent data, still surprising to the upside. What do so many people get wrong, Tom?
I have to say, me and my team, I think we did a pretty good job of sort of nailing the contours of sort of growth thus far. I mean, we thought that things were going to come back in a pretty significant way in the third quarter. And thankfully, it seems like we're going to be sort of right on that idea. I think the one thing that, look, a lot of the high frequency data, which we were early to adopt, has been incredibly helpful. I've said many times in this program, things like home base, that has been early on. It was really helpful in sort of, allowing us to really nail the contours of the upswing in economic activity. I think it's doing less of a good job today, but that's okay. There's other data for us to sort of really latch onto. But I think it's that high frequency data that we've been looking at, that I'm sure a lot of other economists are looking at too. I think that's been incredibly helpful in sort of really nailing things down. I mean, look, I think what we have to keep in mind, and Jonathan, more to the heart of your question, I remember people saying early on, well, you can't just shut down an economy and expect to turn it back on again. Well, but if you have a $22 trillion economy, as soon as you get a little bit of juice, by turning the switch back on, to use that euphemism, you're going to get a pretty decent amount of economic activity.